Guys, everywhere you look right now, you're being told that the economy is in trouble. You look on TV, you look on the news, you look on YouTube, online videos, right? There's fear everywhere. Why? Because fear sells, right? It gets clicks, it gets views, and it keeps people watching. But here's the truth. There are things that are going right in the economy right now. And later in this video, I'm going to show you how you can win and capitalize on this economy as we head into 2026. So stick around for that. And look, regardless of how you feel about President Trump or politics in general, this is an economy video. It's not a political one. We're going to focus in this quick video on the actual numbers, not opinions necessarily, okay? Because the data is really telling a more balanced story than what we're getting in the headlines right now. So let's start off by talking about a little bit of good news, things that are going right in the economy right now. The first one is this. We see GDP growth. GDP growth is pretty strong right now. The U.S. economy grew at 4.3% as an annual rate in the third quarter of 2025. That's the GDP. GDP at 4.3% is pretty solid, right? That's really the fastest pace that we've seen the GDP grow in about 2 years. And it's stronger than most economists were actually expecting right now. So that's real. GDP is real economic output. It's real consumer spending and exports and government spending, right? All of those contributed to a strong 4.3% GDP. That's growth. That tells us that the economy itself is not shrinking right now. It's actually expanding. And again, regardless of how you feel about President Trump, this growth in terms of GDP is not about personalities. It's about actual economic activity happening right now here in America. And that's what matters most when we talk about money. The second piece of good news is the simple fact that inflation has slowed down. Let's keep it real here, right? Inflation isn't gone. It'll never go. Inflation will always be here. Prices will always increase. But inflation is not as high as it once was. So that rate of growth is not what it was a couple of years ago, right? Core CPI inflation numbers are right around just under 3% year over year, which is well below some of those double-digit spikes that we saw a few years back. Now, inflation is still above the Fed's 2% target. We know that, right? But it's really had a massive improvement from some of the earlier pain that we saw. Slower price increases give everyday Americans, consumers, more room to breathe, right? More room to plan, especially when we also see wages increasing as well. Now, another piece of good news, because it ain't all bad right now. Jobs, right? And the labor market. Look, the labor market is not perfect. We know that. We've seen layoffs here and layoffs there in certain industries and so forth. But the unemployment rate right now is still right around 4.6%, which we're looking backwards, right? That was November's reading, but 4.6% in terms of the unemployment rate, that ain't too bad overall, right? That's not a collapse. It's actually near historical normal levels at this point. So it's not panic territory in terms of the unemployment rate. Again, we know it's not perfect. There are certain things in terms of how the unemployment rate is calculated that we don't really see, but jobs are still being created for the most part, specifically in things like healthcare and construction. So yes, job growth has slowed down. We know that. But for the most part, jobs are not just disappearing with only a 4.6% unemployment rate. Now, here's some stock market reality that we need to talk about real quick. And stocks matter because the stock market reflects businesses' expectations, because businesses are always looking forward. And the stock market also gives a good indication of investor confidence right now. So when we look at the stock market, let's say the S&P 500 and other major indexes that are out there, right? Russell 3000, Dow Jones, right? NASDAQ 100. They're all at pretty strong levels as we close out this year, 2025. And even after some volatility, we know we've seen some volatility this year, specifically back in April and then towards October, et cetera. We saw some volatility in the stock market, but markets, for the most part, the stock market is ending the year on a positive note with solid gains, right? Now, analysts, they don't really expect huge returns for the stock market in 2026. That's not what's being projected. They're really looking at more like steady, normal growth in terms of the stock market. But hey, that's still a win compared to a crash that a lot of people were projecting. So even if we have like a modest 3 to 5% market gain in 2026, that's still beating a crash, right? And listen, guys, you'll hear people credit or blame President Trump for what happens with the stock market, right? But markets don't trade on politics alone, right? Markets trade on earnings, right? Inflation, expectations about the future, jobs, right? Those are things that move the needle in terms of the stock market, not simply just President Trump and what he decides to do or not do. Now that we've covered some of the positive things that are happening in the economy right now, let's talk about sort of what that means for us, right? For you as a consumer or as a saver or as an investor, right? This part matters more than the headlines. The headlines are one thing. They're there just to scare you and get you all feared up and make you watch after the commercial break or make you read the article or whatever. That's just the headlines. But how we should prepare is totally different. So here's what this means for regular people right now. For consumers, which we're all consumers, yes, prices are still high, but inflation cooling down means that prices are rising slower, not exploding like they were. Gives us all room to breathe sort of in our budget, so to speak. Now, consumer confidence, we know it's kind of low right now and people feel uncertain, but that's more psychology than the actual numbers. The psychology is not the same thing as the actual data, right? So a takeaway from that is that smart budgeting is going to be powerful and important for you. Intentional budgeting, not panicking, but just being very intentional about where you spend your money as a consumer. Now, if you're a saver and you're trying to put away some money for a big ticket item or you want to buy something, a big appreciating item down the road, the higher interest rates that we've had finally should have given you savers real returns, say on your CDs or even on your high yield savings accounts. Now, if interest rates continue to soften in 2026, meaning that if interest rates continue to come down, the Fed funds rate, locking in your high yields is going to be important for you if you're a person that's out there doing a CD ladder or you have some CDs or high yield savings accounts, right? But keep in mind for savings accounts, those are variable rate accounts. And when the Fed funds rate comes down, the interest rates that you're receiving on those high yield savings accounts are going to go down also. Mortgage rates aren't rising the way they were rising, right? Mortgage rates are kind of stable. And as we move into the next year, if interest rates continue to come down, we may see that trickle down and affect the mortgage rates as well. So refinancing may make sense if rates go down, especially if they go down significantly. Now, for us investors, let's talk about investors, what we can expect based on some of the good news that we have and some of the projections for 2026. Stocks, they're not going to skyrocket every year like we've seen the last couple of years, right? Most people are projecting a normal market coming up in 2026, and that's fine, right? A normal 5 to 6% return, that's okay. Our job as investors is to focus on quality companies with real profits and real competitive advantages, right? Companies with real moats, right? Speaking of that, let me give you real quickly these 8 golden rules of investing that if you're investing in 2026, you need to know these. This is the part that a lot of people miss. Investing is not just random luck. It's really about discipline and having a set of principles that you follow when you're investing. So here's the 8 rules that I invest by that I want to share with you, okay? First, make sure you're investing in 2026 and beyond with a written plan. If your money doesn't have any instructions, guys, your money's just going to wander all over the place and get lost, okay? So have a written plan. Number 2 is stay consistent. Wealth is going to favor the people who are disciplined investors who are not jumping in and jumping out of the market, but you're staying in the market. Maybe you're dollar cost averaging. So stay consistent with your investing. Third thing is this: never invest in something you really don't understand. And if you want to invest in something you don't understand it and learn about it and do your research first. But listen, if you can't explain it, you probably shouldn't own it. The fourth thing is this: always consider risk, okay? What is your risk tolerance level? You need to know how much pain that you can tolerate before emotion starts taking over. Anytime you're dealing with money, you need to consider risk. Now, the fifth thing you got to do as an investor coming up in 2026 and beyond is make sure you diversify intelligently and intently, right? Spread your risk across meaningful categories, different sectors, different types of investments, right? Not just random stuff. You see an article, oh my gosh, let me go invest in that. No, do your research, make sure you understand it, don't panic, and make sure you diversify. The sixth thing is this: only own assets that have real competitive advantages in their industries. or in their sectors, right? Companies with advantages protect your profits, right? Protect your profits that you make on that investment. Number 7 is reinvest dividends automatically. Dividends have a way of compounding that make your investments do crazy things after 10, 15, 20 years. It's how regular, ordinary investors build extraordinary wealth through compounding of not just the money, but compounding of the dividends. The final thing is this. Number 8 is this. If you're an investor moving into 2026, based on all the good things happening and understanding all the risk that's happening out there also, make sure you master your emotions first, okay? Markets move fast. Your job is to move wisely, not fast. Don't panic. Make sure that you master your emotions and invest intentionally with information where you've done your research and due diligence. That way you avoid some of the panic that may kick in if you're investing with emotions, okay? Now, here's the economic outlook for 2026. Let's talk about this. Really important. Looking at some of the things that are positive that are happening, looking ahead to 2026, growth is still expected to be positive. Right? Most of the analysts, when they're looking at GDP moving into next year, they're looking at positive territory, not the gloom and doom that you may see or the fear that you may see, right? Some of the professional surveys project around 2% GDP growth through next year, which is good, right? Also, inflation looks like it could have an average that is slightly above the current levels, but not nowhere near crazy like we saw before. Right? Still very moderate growth in terms of inflation, well below those past spikes that we saw. And the labor market, it may stay stable into 2026. Not a boom and not a bust. But of course, you want to do all the things you need to do to make sure you tighten up your resume, get more skills, and prepare yourself for a possible layoff as we move into 2026. And that's not fear, that's just being real, right? Now, a new Federal Reserve chair is coming in, I think, May of next year as well. And that could shift the whole interest rate policy that we've been accustomed to the last several years under the Fed Chair Jerome Powell. So markets may react to a new policy sort of moving forward after May of next year. Now, none of this, what I'm telling you, is wild hype. It's just data guided expectations, right? It's being logical about what's going on, not watching the headlines and getting all out of whack and out of sorts because of, they're putting fear, emergency, and breaking news. No, this is just basic data guided expectations that we need to be focused on as consumers, as savers, as investors, and as everyday American citizens. And look, as we move into 2026, whoever's in charge, including President Trump, they're not going to control the economy alone, right? The Fed, inflation, jobs, and global markets will matter way more than just what President Trump says or a remark he makes on his social media. Look, in 2026, everything is changing. And honestly, guys, most people don't really see it yet. Your number one job is to pay attention and watch your money. Listen, guys, if you got value from this video, please share it with other people. Anybody who you think needs to hear it. And don't forget to drop a comment. Listen, if you want to really understand how to navigate this thing in 2026 with your money and build wealth with intention, check out my book, Manage Your Way to Millions, where I break this down step by step. And my Smart Money Bro system gives you the tools, the framework, and the plan to build financial confidence, not confusion. Look, stay tuned to this channel for more updates in plain language. Guys, the best person to take care of the old you is the young you. Until the next video, peace.